Hello again, everyone, and welcome to another edition of Silver Bullion Television SBTV. I'm your host, Patrick Vieira. Our guest today is Mark Valek, who is partner of Incrementum AG, an independent investment and asset management company based in Liechtenstein. He co-authors the well-known In Gold We Trust report with Ronald Stoffle, a benchmark report on gold, money, and inflation. A proponent of the Austrian School of Economics, he has great interest in monetary history and the foreseeable paradigm shift in the monetary system. We had the privilege to host Mark and Stefan, the CEO of Incrementum, at the Safe House last month when they visited Singapore. We're delighted to have him here today as our guest. Good day, Mark, and welcome to SBTV.
I'm doing very well. Thanks for having me. I'm excited to be there.
Thank you for having time to come on the show. Mark, could you can we start by letting our listeners know how you came to embrace the Austrian School of Economics and why it made sense to you?
Yes, by chance, I happen to be an Austrian citizen, but that really didn't have anything to do with me finding the Austrian School of Economics. The Austrian School of Economics, unfortunately, is not very popular or widespread in Austria, not more or less, perhaps even less widespread or less well known in Austria than in some other countries. So I studied business administration, also economics. Never really heard a lot about Austrian economics, if at all. So it was really at best a side note. And I was working as a fund manager, already a fund analyst back then. I think before the crisis was already very critical towards the standard view, which I had learned in the university on the monetary system. The monetary system really wasn't a big topic. It was like interest rates go up or down depending how the central bank sees fit, but it was never a question if this whole system really is the best possible system, and if this may be flawed to some extent on a systemic level. However, financial crisis changed everything, and I learned about the Austrian school via the internet, and then happened to meet Rahim Tagizadigan, who is also co-author of our book, Austrian Investing. And he's extremely knowledgeable about Austrian investing. I learned a lot about him via him. He gives courses in Vienna. I also went internationally to learn about Austrian economics, and I became passionate. It was like really pre and post me discovering Austrian economics. My whole worldview changed fundamentally, and it just made so much more sense. And yeah, that's basically it in a nutshell.
It seems that the current monetary system functions on Keynesian economics, and even most schools and universities, they'll teach Keynesian economics. Your views on Keynesian economics, do you think it's a flawed system, or do you think we'd have a better monetary system today if it were based on the Austrian School of Economics?
Yeah, I mean, the thing is, this is really not only an economic question at the end of the day. It also is a social question. It also has to be. I mean, at the end of the day, the question is how. What is the role of government? What should the role of government be? And if you don't have a consensus about that, that you need really a very limited small government, then you probably also have a really hard time implementing Austrian economics, which then again would probably suggest a very hard monetary system, for instance, a gold-backed monetary system. Because if you don't have this consensus within the society, that you really have to have a small role of government, then it's basically impossible to keep up a hard monetary standard, which then again leads to some kind of inflationarism, which again probably is also philosophically then leads to Keynesianism, right? So it's really, in my view, one has to see this in a whole broad context.
Last year, 2017, gold price went up by about 12% or so. This year, gold has really been taking a beating. I think we're still around $1,200 per ounce right now. But in your opinion, what factors do you think is causing the gold price to fall this year and have a hard time just trying to get to back to the 1350, much less 1400 level?
Well, a lot of factors. I mean, generally, you're obviously referring to the dollar
Yes.
price of gold, um, which is fair because the dollar still is the leading reserve currency. However, just to also note this at this point, if you quote gold in various different currencies, the picture is a different one, a completely different one, which goes back to the currency question. Um, Dollar is doing very well, is very strong, especially versus emerging market currencies this year, which again is probably one function of rising interest rates. So actually, the interest rates have been rising quite steadily
Yeah.
since one year now, 1.5 years, and this is obviously headwind for gold. Um, yeah, so then we can go back and ask, why is this happening? The US economic data again looks pretty well. At least if you look on the surface, the GDP growth is doing very okay actually, and Trump did do was a determining factor, I think, to push these numbers higher. If this is a sustainable growth, I would doubt that. But for now, it's just like the US is looking pretty good for most of the investors at least. So the central bank can go ahead and try to normalize the monetary system. They are far from doing that right now, because if you look at the balance sheet, it's still hugely bloated and so on. But just from an interest rate point of view, the US is doing quite well, and this is a headwind for gold. I'd say that's probably the most important factor for now.
Would you say the reasons for owning gold are still strong despite the somewhat negative sentiment about the asset right now?
Oh yeah. So there is no doubt about the sensibility in owning some gold at least. Question is how much in a portfolio context. But I think if you don't hold gold, you prove to be very ignorant to history, basically.
Yeah.
Economic history, financial history. It actually doesn't even depend on which, I don't know, economic school one might adhere to, but just look at the past, and gold really proved to be quite a good diversifier within the portfolio. It at times performs better when other assets don't perform very well. But on top of all this, and that's, I think, very unique to gold, it has no counterparty risk. It really is nobody else's liability, which in a world of over indebtedness is a very important factor and a very important property. So all of these characteristics, I think, speak for gold, for some allocation at least to physical gold. And on top of this, if you happen to adhere to the Austrian school, which also has a very interesting business cycle theory, then you really doubt the sustainability of this, for instance, US extensions. I mean, you saw this expansion going on for 9 years already. It's already in the 10th year. Historically, a very long business cycle already. So the question is, going back to the interest rate argument, how long can the Fed keep raising interest rates without kind of breaking the back of this expansion? And as I said, if you have a more Austrian view, then it's probably you probably more you attribute the scenario a higher probability that this business cycle is not sustainable and is probably more at the later end already, which enhances the chances of a positive gold performance sooner than later.
Okay, that's a great point, Mark. In your publication, 2018 in Gold We Trust, and speaking of the interest rates, James Rickards, he believes that revaluing gold at perhaps $5,000 an ounce may be a better way for the Fed to reach their target of 2%. What's your opinion on this? Do you think it's a feasible idea and something that the Fed should seriously be looking at?
I mean, this is a very interesting angle. I mean, Jim Rickards is looking, I think, on historic events, also in comparing this, especially 1933, when the U.S. revalued the dollar. Actually, one should say to from $20 an ounce to $35 an ounce. Actually, they depreciated the dollar relative to gold, expressed in gold price. The gold price rose, and actually in fact to reflate the system. It was a very desperate measure to reflate the system, which was battling with deflation after during the Great Depression, after the big crash 29, and it worked. It actually worked, and Jim Rickards argues that it would work just as it worked back then. It would work today. I think this is a very credible view which one can have. I definitely think that basically sooner or later the actions which the Fed already has taken will lead to a kind of outcome you're talking about. I don't want to give any number on the gold price for this now,
Sure.
but basically they wanted to reflate the system through all the quantitative easing of the financial crisis. It also, I think that's also very interesting, reflected itself in higher commodity prices, in higher inflation rates, and especially until in the first phase until 2011. Interestingly enough, since 2011, since 2012, disinflation was more took already more control, and that's and we saw more of a financial inflation, asset price inflation after this time. So that's quite an interesting break. I think 2009 to 2011, reflation hitting real inflation kind of, and since then actually only or more or less more financial or asset price inflation, I should say. So the gold price again is reflecting kind of this disinflationary scenario right now, and it would be kind of also showing up more north once the US gets more inflationary environment, which again goes back to the US dollar probably. Once the dollar gets weaker, you probably are more likely to get the inflationary environment, which you need to have these higher gold prices.
That $5,000 per ounce for gold scenario. How did Jim Rickards come up with that number, $5,000 per ounce?
Well, I think he gives a very clear answer to that. It's arithmetic. If you like do some kind of games with the money supply, and these numbers which he calculates, he bases on a historic quota of a gold backing, which was between 20 and 40% during the 20th century, generally, roughly speaking. So you can do various math games, which money aggregate you want to take, and then do a kind of division. If you say you're thinking about a 20 or 40% backing, and then you can get to higher prices easily also. So this is very easy to calculate. But I mean, there are a lot of variables here. So the outcome of this number could be very large, and for that I take it with a little grain of salt, honestly speaking. But he has absolutely got a point. Once the global monetary system really takes into account that gold really again may be a part of a formal part of the system, then I think we can think about these kind of numbers easily. But we're not there yet, obviously.
Okay. Oh, it does make sense. I mean, if you look at it from a mathematical standpoint. But in continuing talking about our favorite people over at the Fed, page 91 of your publication, again in Gold We Trust, the Fed's balance sheet has gold at $42.22 USD. Why is this so? Considering gold is roughly $1,200 an ounce right now.
Yeah, that's a very interesting question, and it also doesn't hold, by the way, for the other big central banks, or for some of them at least. For instance, the ECB, but also the SMB, if I have this correct off the back of my mind. They do kind of a market-to-market accounting for the gold price. I think the $42 are historically, because once the Bretton Woods system broke up in the period of 71 to 73, basically, they did one kind of appreciation from 35 to 42, but they never kind of adjusted for the rest of it. I heard one opinion which seems also kind of plausible, or interesting at least, that if you look at ECB versus Fed, which have a different accounting for the gold price, argument would be like, if you have a central bank which are marked to market, the central bank takes gold more serious still, kind of. I mean, the Fed never wanted to kind of post Bretton Woods acknowledge that gold really is a big part of the system, whereas implicitly speaking, interestingly enough, ECB, or back then the Bundesbank of Germany, always took gold more seriously from an accounting point of view, which may again also speak for its view on gold in terms of a monetary asset. So that may be a reason. I can't offer you any better answer for this right now, but it's an interesting fact.
Yeah, at $42.22 per ounce, being the reserve gold price, they would really have to reevaluate that quite a bit to move up into 2018. But let's say if gold should get reevaluated again, to, let's say, that $5,000 per ounce, which Jim Rickards is talking about, how is that going to look for the average man on the street who has some gold? How is it going to look for asset prices, or real estate prices, or even just everyday items at the grocery store?
Well, the idea is you can't only revaluate on your books. You need kind of to make a market. So basically to say, okay, we are buying, in your example, the Fed would have to do kind of an open market operation and says, okay, we're buying gold if it's below 3,000 or 5,000 USD, and we're selling our gold if it goes higher, if they want to fix the price of gold to $5,000. So basically, there would be, first of all, if this would be done overnight or very, very, very rapidly, there would be, I think, a huge shift in gold allocations. I don't know if a lot of people would sell their gold at once, but there would be quite a reallocation of gold ownership, perhaps within the months to come. But the effect which it should bring, if they take this decision, is that this revaluation and this new market price, which it is for gold, which they would make then for gold, kind of pulls up the other commodity prices, pushes down the dollar, relatively speaking, which then obviously has direct impact on price inflation. So within months or at least 1 year, I'd guess, you definitely have, I don't know, a huge spike in inflation, at least a one-off, and by this you could revalue the debt, which would be probably the motivation to do this, because you have this ever-increasing debt burden, which you really, as a state, have to stay on top of it in terms of your income, and if you don't have enough tax income, you really would have to revaluate this debt and increase your nominal income. That would be probably the ultimate motivation for such a step, to kind of get ahead of the debt situation again, which would push the cost of this whole intervention on the man on the street by reducing his standard of living, by kind of robbing his savings, if he had any at all, or making his life significantly more expensive. So that would be the main consequences. It would lower the standard of living for the average Joe.
Yeah, I think there's also the concern, because in that scenario with the dollar devaluing, the rest of the world, what would they do? Would they also then have to devalue their currencies, or I mean, just to stay competitive?
I mean, I think the 70s are quite an interesting period to look at. You didn't have like a formal revaluation via open market operations, but nevertheless you had gold prices rising a lot from 35 beginning of decade to shortly over 800, but going back to 400 kind of. So huge increase of gold prices, and along with that also increase of oil prices, but also all kind of commodity prices, and vice versa, a very weak dollar. So you had quite a high inflation in the US, but you didn't have as high inflation, for instance, in Europe, as the local currencies were relatively strong to the dollar, which kind of provided a buffer in terms of the inflation rates there. So really depending on how the FX rates behave, the inflation would then kind of emerge in the different currency areas. Just take a look right now what's happening. As I said in the beginning, we have now the opposite. We have now an extremely strong dollar, and we have very weak emerging market currencies especially, which then gives them the inflation, leaves them with the lower living standard de facto, and that would be, my guess would be that would be more vice versa. The bad times would then probably move to the US, and perhaps relatively speaking better times would move to the non-US dollar jurisdictions.
Yeah, okay. Hey, I got to put you on the spot here. Gold hits 5,000 an ounce. Are you holding on to it or are you selling?
Wow. I mean, de depends on, first of all, it's not a question, a binary question, yes or no, no gold
Right.
or all in gold, but perhaps I would reduce my allocation. Perhaps I would increase my allocation. I think the main question is, are we on a sustainable path to finance the debt in this kind of environment? Um, and is there a chance to have a longer period of positive real interest rates? So I think the real big question is, how will real interest rates develop? And if the scenario would like be more likely that we are seeing real interest rates going higher, or at least staying in somewhat positive terrain after such a kind of intervention, then I might be likely to reduce my allocation. If this revaluation, whenever this may take place, wasn't enough, because at that point of time the debt is even higher, a lot higher than it's now, perhaps that wouldn't convince me to reduce my allocation, because the debt is still not sustainable. That's basically a question of debt relative to growth, and debt growth relative to GDP growth. Right now, we are definitely not on a sustainable path.
Yeah, it's it's a question we like to throw around at each other. If gold hit a certain price, if we would sell or hold, and but I think the thing is, it also depends geopolitically on the world. What shape is the world in if gold were to ever have to go to 5,000? So then it becomes a matter of, do you really want to sell it to go back into fiat, or do you want to hang on to it as an insurance, because surely the monetary system is going to change if it ever goes up to 5,000 per ounce. But speaking politically, both U.S. President Trump and Vice President Mike Pence, they have talked about some type of gold backing for the U.S. dollar before. Um, do you think they actually have the political will to do this, or if they're even capable to do this, or for this to be done, for that matter?
Yeah, that's a very interesting topic, which we covered also in the 2016 Gold We Trust report a little bit. We quoted Donald Trump in various different modes, I should say. Like on the one hand, he was like sounding quite positively relative to gold. But on the other hand, he was bragging that he's a low interest rate guy, and he's the king of debt, and he knows how to handle debt and take advantage. So that was a little bit of a incoherence there. Um, I think if you look at the system as a whole, it is really prone to inflation and inflationarism, and it's also going back to what I said in the beginning. Is the public able to really cope with a lot less state intervention? Is
Yeah.
the public or is the state willing to cut the size of government, which would be required to go off this inflationarism, and go to something like gold, for instance, and stick to it also? Um, I think the question is clearly no. I mean, in the case of the US, you have giant military spending. You have also welfare spending in increasing. So this is not the question now, in my view. Realistically, there would have to be a fundamental political change, but also from the public. The public would really have to demand
Yeah.
fundamental changes in the foreign policy, and I think this is no discussion right now. So
Yeah.
it's not realistic.
Okay. Yeah, I was going to ask you about that. What would it take for the mindset of the public to actually start demanding that their currency or their money have some type of gold backing?
Well, one thing could be inflation. So if you really have significant price inflation, then that makes things a lot more difficult for governments. So people really aren't happy if it's obvious that their standard of livings are decreasing. Right now, it's, in my view, not as obvious because first of all, they're like probably trying to keep the inflation rates lower, the statistics, than they actually are, and so on, and they're able to kind of keep up the facade that things are going up for most of the people. But then again, the political results tell me that there's a lot of already critical thinking to in this respect. So, but for now, it's still, they're still able to maintain this picture that everything is going up. If you have real, obviously high inflation rates, people, I think, start to get nervous pretty fast.
Historically, the delinking of gold or debasements of gold that governments often go to, uh, they call it financial innovation. It opens them up from being restrained. But what would your response be to people who say that taking away the gold standard is exactly what governments need?
My response would be study monetary history. I mean, it always went to in cycles, kind of, right? I think the really difficult thing about it is that at first these measures seem to be providing more prosperity. That's also a little bit like Keynesianism works. At first, going into debt feels good, right? And people say, okay, why shouldn't we go on with it? Because actually nothing happened, and let's go into debt further, and okay, and then do it on and then increase the debt. At the end of the day, if you look into more of an historic perspective, it's not sustainable. It wasn't sustainable back in the Roman Empire. It wasn't sustainable in China when they started paper currency. It wasn't sustainable in France, and the list goes on and on and on. And it's not sustainable this time. That's at least my conclusion. So study monetary history, and if you get smart on that, probably hold more gold if you look what's happening in the world right now.
Mark, you mentioned the competition to gold, and a lot of people are thinking that it could very well be cryptocurrency. I do understand that you are working on a cryptocurrency report. Could you tell us a bit about that and how it can benefit us?
Yeah, and what I also like about the fact that this cryptocurrency space is out there is that people think about money more. You can be very dogmatic about the discussion, is gold better, is cryptocurrencies better, and it gets very emotional from times to time.
It does, yes.
But I think we should all at least agree on the fact that it's great that the crypto theme brought in a whole new kind of critical crowd, generally younger crowd, thinking about money, first of all, thinking on alternatives of the current money. And as this discussion is being increased in publicity, it's fascinating for me just to follow how people react towards this phenomena. Okay, so we decided that really it is not like an either or question. It's not like will it be gold, will it be cryptos, but for us, we took kind of the strategic decision. We came to the conclusion that the crypto phenomena will not disappear. It's just here to stay. and we have now hired a few people actually. First and foremost, Demelza Hayes, my colleague, who is in charge of our crypto research report, which is the sister report of our In Gold We Trust report. It's a quarterly publication relative to the Gold We Trust report, which is an annual publication, which is thought the crypto space moves much faster. So we have to do higher frequency here, but it's not as a brick as the gold report is. And we're really trying to learn with the industry, with people. We wanna kind of spread what we learned about different technologies, also how this fits into the monetary system going forward. But what else is possible with the crypto, in the crypto space, and I think you can get the gist of it. I'm not like the super enthusiastic guy who says, okay, crypto, this is it now. But we think one should be on the ball of this topic and follow it if you are really interested in what's also the monetary system going to be in the future. You have to have kind of an idea what's going on with these new technologies.
Yeah, I've run into a few people who have they have the same sentiment. But your cryptocurrency report, we can download it, correct?
Right. So both reports actually have the name where you can also download it. It's cryptoresearch.report. Okay. Or it's ingoldwetrust.report. These are the URLs for both of the reports. They are downloadable free of charge, and looking forward to get new subscribers. Our mission is to spread the message. We really want to have the maximum possible of audience to read our thoughts, and it seems that we are filling some kind of a gap, because our subscribers were going up and up and up in both cases. Obviously, the crypto research report is a newer report, but also the crypto research report so far has been a very good success. So we're very happy with that product.
Yeah, we appreciate the work that you've been doing, and especially keeping people aware of monetary system and things that we do need to know that either we didn't know or perhaps things we've forgotten. But are there any other developments going on at Incrementum AG that you could share with us?
We are working on crypto fund also, which is from a regulative point of view difficult to talk about too much in detail, but sure. I can say that we're working on it. It's one of the first regulated funds. Very interestingly, Liechtenstein as a jurisdiction has become very friendly to the whole blockchain scene. In our next crypto research report, which will be out end of September, I was able to interview the Prime Minister of Liechtenstein, and quite interesting his motivations and the motivation of the government, why they actually have this strategy. And it's a very interesting time for us in this field also. That's basically probably the biggest news from our side.
Great. We wish you well with that. Wish you all the best, and we'll be looking forward to that report and others coming out. But Mark, Valek, thank you very much for coming on the show. It's been a pleasure speaking with you, and we hope to have you back again sometime.
Thanks so much, Patrick.
Sure. Again, wait, can you say I'll be back?
I'll be back.
Oh, there you go. That was Mark Valek from Incrementum AG and the co-author of the In Gold We Trust report. For more of his insights on precious metals and the global economy, please visit his website www.incrementum.li. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content.